So the momentum for the economy is still strong. I mean, we're going to see a moderation of the pace of recovery from earlier in the spring and the summer. I think the concern for the economy at this point in time, though, is whether consumer spending can hold up because of the fiscal stimulus package hasn't been passed yet. So far, the consumer spending has been quite strong, and that should stay the case. But I think it's sort of the near-term risk is that if we don't get something in September, there is a risk that the consumer could start to kind of pull back a little bit. That would put some of the recovery at risk.
Yeah, Tracy, would you say that's priced in? I mean, we thought we were going to have this big deal in Washington. Now maybe it's a skinnier deal, a smaller one, but it's still something, although, nothing's done until the ink is dried, so to speak. What are your expectations?
Yes, we also think that the consumer is under quite a bit of stress here. Unemployment levels continue to be very high. Claims came in again this week at 1 million. So another 1 million people unemployed. So that is definitely weighing on the consumer. So the key here is, do we get that additional stimulus or not? And our belief is that we will get the stimulus. It could take some additional weakness in the consumer. It could even take some market weakness before Congress comes together and passes that package. But that's really what we think it's going to take.
Jason, where would you be in the market? I mean, as we're talking about these risks, especially, the consumer confidence number this week was not great. So, you could say as an investor, all right, you have to think through these scenarios. It weakens a little bit. We get the move from Congress. Boom, we can kind of look through to the other side. Are you rotating? Where are you? Tell me about, tactically speaking, what's your advice here?
So we're not rotating. Like we do like equities. We think there's still more upside. I think we're going to get that fiscal policy package. And it's also, on the medical front, things are progressing there that, I think will buoy the market. It's going to keep the market from pulling back too much. But for this rotation that the market's been debating about in terms of growth versus value, we're neutral there. Where we'd like to get some more maybe exposure to potential recoveries in mid-cap equities. Typically, they perform well in the recovery stage, and they haven't outperformed just yet, but we think that's going to kick in. And it doesn't quite have the exposure to, say, financials that the value trade would have. And then in terms of kind of the global recovery, industrials is another sector that we like. So we're kind of dipping our toes, you could say, into like adding a little bit of cyclical exposure and recovery. We still think that's going to materialize. I think until we get a clear signs of a full-scale recovery, I think that's going to require a vaccine. I think that's the market consensus. You're not going to get that sustained rotation. So I think just overall being allocated to equities versus fixed income, but not being sort of overly aggressive in terms of taking cyclical risk at this time.